Hey guys, and welcome to this week's Finance in 5, where we take you through the 5 best things we found in the world of finance and property this week. Josh and Jaden here. Starting off from the top, Josh, property pain across the markets. What is happening?
Yeah, in the most recent edition of the CoreLogic Pain and Gain report, which was released in the June quarter, we saw that nationally houses had a higher rate of profit, with 89% versus 79% of units. And the ones who were worse off were the investors. Unfortunately, on average, 18% of them making a loss.
So according to the report, quarter on quarter, the proportion of losses was only up about 0.5%. And that's a bit to be expected, because even though it was sort of in the midst of COVID and all those first stage lockdowns, a lot of the banks allowed people to go on mortgage payment deferrals. So in other words, they could pretty much put their payments on ice for 6 months, add the interest to the loan and not have to make any repayments. So as a result, people weren't forced to sell, and there were much less stock on the market. There were way less people selling, and they were just kind of sitting on their hands waiting for it. I found this one pretty interesting too. It's obviously Brisbane specific. There's all different articles from Melbourne, Sydney, and everywhere else. But in Brisbane, the profit, the proportion of people losing money on units was a fair bit higher compared to houses. But the stat I really liked was this one here. So the typical hold period of loss-making sales was relatively low at 6.2 years compared with profitable sales with a medium hold of 10.6 years. So it just goes to show with property, it's really not about timing the market and being like, all right, well, I think this is the time when it's going to be the best time to buy and I'm going to make all this money. It's all about time in the market. So like you can see there, just by holding it an extra 4 years, people were more likely to make a profit, and the numbers don't lie. So it's worth thinking about. We always get asked every day, like, is now a good time to buy? When's the right time to buy? It's markets within markets. You've got to learn your local area and work out what's going to work for you. And remember, property is not a short-term buy and flick sort of thing. All right, Josh, our second point, not as safe as houses. Rental prices were down in the September quarter. So nationally, the asking rents for units dropped 4.2% to March, while national housing rents regained a bit in the last quarter. So what's been the cause of some of these drops in the rental values?
Yeah, great question, Jaden. And according to the Reserve Bank, 2/3 of renters are under the age of 35. And this group makes up a disproportionate number of younger Australians who were affected by COVID. The most affected industries that these people work in are accommodation, the food industries, and the art industries. Overall, there has been a reduction for demand in these industries, and as a result, has had a softening effect on the rental market. Much can also be attributed to border closures. Treasury forecasts that the Australian population will decrease about 1.5%, or about 400,000 fewer residents. This resulting in decline means that we've had a national decrease of about 3% in rental returns, with the most affected being short-term accommodation, over a 20% decrease in listings, or about 40,000 on places like Airbnb.
Yeah, so it's important to remember that most of the bad news is coming out of the inner city unit markets. So in Sydney and Melbourne, unit rent prices recorded declines, but Perth and Adelaide actually saw increases of $20 a week. Yeah, across most capital cities, weekly rents for houses are actually up. And you've got to remember, as the borders start to open nationally, it's probably going to help a bit more of that interstate migration. And then going into next year, as we start to open up internationally, it's probably going to help some of these inner city rental markets increase the demand.
And on to our third topic, rates to remain low until 2023. Great news, isn't this, Jaden?
Yeah, so the Reserve Bank Governor, Philip Lowe, has pretty much gone out there and said, hey, we want to keep the rates on low for as long as we can. So over the next 3 years till 2023, he's pretty much said we're going to keep it low. We're going to try and make cheap money. So you can see that by a couple of the banks out there. They've got 2 and 3 year fixed rates that are 0.5%, sometimes 1% lower than their variable rates, because they're just trying to stabilize the market, give people confidence, and just know that they're not going to jump up anytime soon.
And while interest rates are set to stay low, remember that on average over the last 40 years, they have been around 7%. So there are a few things you can do to be prepared if they were to increase in, say, the next 5 or 10 years.
Yeah, so I'm a big believer, especially if it's your home, in making extra repayments. So maybe calculate your monthly repayments based off a 3, 4, 7% interest rate if you can afford it, and make those extra repayments, because in effect, you're going to take years off your home loan.
And on to other news. Jaden, I think I struck it big. I think I have a $200,000 Pokemon card.
I'm not going to get into investment advice here, Josh, but Yeah, Rapper Logic has just bought a $200,000 Pokemon card, mint edition Charizard, which I'm kind of upset about because my 1994 gold Andrew Eddinghausen NRL card's not probably going to be worth quite as much.
Yeah, Jaden, when I saw this story, I thought I had struck it gold with my limited edition Charizard. Mint, absolutely mint. Check that out. But I'm afraid I found out it wasn't a first edition.
Yeah.
There goes my retirement strategy.
Yeah, I'll give you $5 for it. Trade you Andrew. And number 5, guess who's back? Back again. Confidence is back.
That's right, Jaden. And according to Westpac's consumer sentiment data, the percentage of Aussies who think it's the right time to buy a property increased 10.6%. And this is at a level we've not seen since September 2019.
Yeah, I think it makes sense. Like, you've got to just put your memory back to sort of Jan, Feb this year, when all the experts were coming out and saying property is going to drop 20, 30, 40%. It's going to be a bloodbath. Get out, sell your property, just get out. Whereas it just hasn't quite come to pass. So from peak to trough, CoreLogic's latest data says property prices have only dropped 2.8% nationally. So that 40% stuff just hasn't happened and looks pretty unlikely to happen, especially if rates are going to be down this low for the next couple of years.
And there you have it, Finance in 5 for this week. What do you think? We'd love to hear your comments below. And remember, hit that subscribe button to keep up to date with all the latest property and finance.